So you're welcome to another episode entitled The Acquisition and Disposal or Sale of Non-Current Assets by an Entity. So today we are going to learn the accounting procedures in case you've been given a question and the depreciation policy and everything, but this entity is selling or acquiring a new asset, new non-current asset. How do you go about it? So we have a question that will be displayed on our screen. I have it here. There's a trial balance, extract or a trial balance being given to us. The following trial balance is an extract from the books of FinAccount Enterprise. So it's only an extract. That means that it's not a complete trial balance. So it's only the asset portion that I've given. We have land and building 25,000. That is the cost of land and building 25,000 at the debit. The reason why is at the debit because assets or non-current assets are having debit balances. Plant and equipment 15,000. Office furniture 18,000 and motor vehicle 5,000. We have the accumulated depreciation, building 10,000, plant and equipment 6,000, office furniture 9,000, and motor vehicle 2,000. Additional information. 1. It is the policy of business or policy of the business to depreciate building and plant and machinery using the straight line method. So land and building and plants and machinery, straight line method, and also depreciate office furniture and motor vehicle using the produce balance method. The rate of depreciation 10% and 5% respectively. That is the first set of assets, land and building, plants and equipment are taking 10%, whilst the next two sets of assets, office furniture, motor vehicle, are taking 5%. 2. During the year, the company acquired a new building with a cost of 3,000 cedis on 2nd March 2020. Another motor vehicle, that's number 3. Another motor vehicle was sold on the same day that they acquired the new building with a cost of 500. That means that they sold a building. On 2nd March. That's the same day that they acquired the new building. So, depreciation is charged in the year of acquisition, but none in the year of disposal. What it means is that, let's come to the additional information for depreciation is charged in the year of acquisition, but none in the year of disposal. It means that when you buy an asset, whether in January, February, March, you must assume and charge full year depreciation for it. But if the same year you are selling an asset, whether the asset was being sold at the last day of the year, you don't charge depreciation for that asset. That is a policy. Someone can say that they charge depreciation based on pro rata basis. Pro rata basis means that it's in proportion. So the month or the year that we are selling the asset or we are acquiring the asset, it must take into consideration the month that we sold the asset. So imagine the asset was bought in 2020. We've used in 2020, 2021, and we are in 2022, May. That is, the asset has been used for almost 5 months. 2 years, 5 months. In this scenario, if it is based on pro rata basis, we will assume that the asset has been used for 2 years, 5 months. If it is not based on a pro rata basis like the one that has been given to us right now, then what we have to understand is that the 5 months that we are assuming that in 2022 we have consumed as depreciation, we are not going to charge depreciation for the 5 months. So it's assumed that the asset has been used for 2 years. That is what it means. When an asset is being sold or when an asset is being acquired, definitely the accountant is supposed to record it. But the moment it's been given as part of our additional information, it means that nothing has been done. And let's see. During the year, the company acquired a new building. You acquired a new building either in the form of cash or check. So it's either it's going to affect the cash or it's going to affect the bank. Good. So here we are just assuming, and I'm going to teach you how to go about it. So first of all, we have to draw our non-current asset schedule. Non-current asset schedule. Simple. And for you to do this, you give the heading. The first thing that I said is that you list all the non-current assets that have been given. If you see the question, you see that it's land and building the trial balance, but when you come to the additional information, it's just building. The reason is that we don't depreciate land. Land always appreciates in value. Therefore, land is not going to be depreciated, but they have combined land and building value together. That's what it means. So, we list the items here. Land, building. We have plant and equipment. We have office furniture. We have motor vehicle. And we have the total. They're very important. So you bring your CD sign. If there are 3 zeros, you add them. I said the first thing you do is to establish the cost for these non-current assets. That's the first thing. And that one, you go to your go to the trial balance. So land and building is 25,000. That's the cost. Plant and equipment is 15,000. Office furniture is 18,000. Motor vehicle 5,000. So the total assets 25,000 plus 15,000 will be 40,000. Then plus 18,000, you'll get 58,000 or 63,000. Then you go through the question. From the additional information that we just read, it can be deduced from this additional information that the company acquired an asset. So we say addition. So which asset did they acquire? That is the question. So they acquired during the year, the company acquired a new building. So it's here. Building with a cost of 3,000 cedis. 3,000 cedis. 3,000 cedis. None for plant and equipment, office furniture, motor vehicle. So total will still be 3,000. Then you ask this legitimate question that did the entity dispose any non-current asset within the year? If they did, you bring disposer. And I know this question, they also disposer. When you are disposing the asset, you don't bring the cash proceeds. It's not about the cash proceeds, it's not about how much the entity sold the item for. But since we are dealing with the cost portion of the non-current asset, we are going to use its cost. So we are lucky that in this question, the cost was being given to us. Another motor vehicle was sold on the same day that they acquired a new building with a cost of 500 cedis. So that was the cost for this. So the cost, motor vehicle, 500. I'm putting it into bracket because disposal, it means we have to less. We are selling, it's no more with us. So finally, these are the real transactions. What will be the total here? Right now, land and building will be 28,000. Plant and equipment will still be 15,000. Office furniture will be 18,000. This motor vehicle will be 4,500. So when you add the 4, let me take my calculator. And you add the 4, it will be 28,000 plus 15,000 plus 18,000 plus 4,500, which will give us 65,500. Or you can go by this section, it will be 66,000 minus 500, which will be 65,500. Then you come to the depreciation section. Here is the most important thing. So take your time and listen to this. Right now, we know the cost of these assets are this currently. But the main purpose for us drawing this table or schedule is to determine the net book values of the various assets we have. And when you say net book value of an asset, it's the same as its carrying value. That's the difference between the cost of an asset and its total depreciation. The cost of an asset or the total cost of an asset and its total depreciation. So depreciation, first of all, you ask yourself, has these assets suffered any previous year depreciation, that is what we say accumulated depreciation or provision for depreciation. I prefer to use the accumulated depreciation because it gives the exact meaning I'm trying to arrive at, because accumulated, it has piled up for the previous year, so accumulated. Let me use another marker so that we can differentiate it well. Accumulated. So we go to the question, accumulated depreciation. This is 10,000. This is 6,000. This is 9,000. And this is 2,000. So what will be the total? 10 plus 6, 16, 25, 27,000. Good. Now the question is that, let's go to additional information 4. Depreciation is charged in the year of acquisition, but none in the year of disposal. Depreciation is charged in the year of acquisition, but none in the year of disposal. That means that we are going to charge the current year depreciation that we are going to charge. We have to take into recognition the asset we bought within the year, whether it was bought on 1st January or it was being bought last day of the year. It's very, very important. So, but before we do that, we have to know that we are disposing one asset. If the asset that we are disposing, we've been able to take its cost from the total cost, then its depreciation that has been set aside specifically for that asset we are selling must also go out. So a classical example is forming a SUSU group and we contribute. So one of us decided to expel one of the SUSU contributors out, that the person doesn't qualify to be part of this. What it means, that first thing that we are going to do is to cancel the person's name. And there's no way we'll cancel the person's name and the person will say that the amount of money I have contributed, I'm leaving it. No, the person will take its money alongside. So we'll be able to take the cost of the asset we are selling, that is a motor vehicle. It means that its associated accumulated depreciation must also be taken from the total depreciation to actually get the rest of the asset left in the company's accumulated depreciation. So we come to disposal. But this disposal is not the cost, it's the accumulated depreciation. So with this example, it was just a question that came. What we are going to do is that the company's year ends in December 2020, 31st December 2020. So what we are going to do is that the motor vehicle that we sold, that's what we are going to work. We have to determine its total accumulated depreciation. So let's take that, let's say that we bought the asset in 1st January 2019. 1st January 2019. 1st January 2019. If it is 1st January 2019, it means 2019 we are going to use the asset. 2020 we are going to, but according to the policy, they are saying that none in the year of disposal. So 2020 is the end. Let's say that 2021 is the end of the period. So let me write it here. End is 2021, 31st December. That's the closing year for the company. And we bought this asset, motor vehicle was being bought, the one that we are selling was on 2nd January 2019. 2019. So let's see. And we are selling it in 2nd March 2020. So let me make it, this is 2nd March, so the end should be 2021. This should be 2018. 2nd January 2019. We sold the asset in 2nd January. You can write it in your book. We sold it in 2nd January 2018. This is just an example. So that's why I say it's an extract. You can get it as part of a question. And this is how you go about. So the main closing date is 2020, 31st December. That's when we are preparing this statement. And we bought the asset that we are selling on 2nd January. That will be given to you in the question, but this question is an extract. That's why I didn't bring it. 2nd January 2018. So how many years have we used the asset? So 2018. So we bought it in 2nd January 2018 year is part. 2019 is part. Then it was being sold in 2020. But since, according to the policy, they are saying that depreciation is charged in the year of acquisition, but none in the year of disposal, the year that we are selling the asset is not important. So we sold the asset 2nd March 2020. So 2020, no depreciation will be charged. So the depreciation that we will take into recognition are just 2018 depreciation and 2019. That means that this asset has been used for 2 years. So let's check for the accumulated depreciation on disposed asset. On disposed asset. This one, for you to know, you must know the method for depreciating the asset, the rate. We depreciate motor vehicle for office furniture, motor vehicle at 5%. And what is the method? Is it produce balance? So that means that produce balance means reducing balance method. So reducing balance method, we can't use a straight formula. We have to go and compute year 1 depreciation. So year 1 should be 5/100 times its cost. The cost was being given to us 500. So 5% will be 25. Year 2, since it's produce balance method, year 2 depreciation will be charged on the net book value at the end of year 1. So which will be 5/100 times, as at now you must know, we take 25 from the 500, making 475. So what will be the year 2 depreciation? So just 0.05 times 475. Then you get 23.75. So let's make it 24. 24 approximation, 24. So in all, the total depreciation for the 2 years will be 49. If the asset that we are selling, its method of depreciation was based on straight line method, then that one, year 1 will be 5% of 500, year 2 will be 5% of 500. So it will be 25, which will be 50. So you can deduce from this calculation that when you are depreciating an asset on straight line method, it goes faster. By reducing balance method, you can see the same amount you can see. Good. With the same as the straight line method, we could have just applied 5% on the 500 times 2 years. It will give us 50. So 5% times 500 times 2, it will still be 50. But if it is reducing balance method, you have to go and do this calculation somewhere and you bring. So the total accumulated depreciation that we are looking out for will be 49. So let me clean it. I want to be 49. So we bring the 49. Suppose our motor vehicle 49. No disposal for the rest of the assets. So here when it comes 49. Then you come to current year depreciation. Current year. With the current year depreciation, we are going to base the rate on the method that they are letting us to depreciate the asset. And don't forget about the last policy. Depreciation is charged in the year of acquisition, but not in the year of disposal. So which means that the asset that we acquired on 2nd March 2020, we must assume that it has been used in 2020, and therefore we won't prorate the number of months. Maybe it was acquired on March, so you are saying that, oh, let me find the ratio of the months that the asset. No, this one, assume a full year depreciation. So with year land and building is based on what straight line, and what is the rate? 10%. So 10% on 28,000. 10% on 28,000, and it will give us 2,800. 10% of this will give us 2,800. Then let's see plants and equipment. Plants and equipment. Or plants and machinery. The same thing, straight line method. 10%. 10% of 15,000 will be 1,500. Then we come to office furniture. Reducing balance. With office furniture, since it's reducing balance, what it means is that we must take the previous year accumulated depreciation from the cost before we apply the rate. So 5% multiplied by, you can take in your book, 0.05 times, if you take 9,000 from 18,000, get 9,000, so times 9,000, and get 450. 450. Then you come to motor vehicle. Motor vehicle is the same as that is a reducing balance. So with the reducing balance method, currently, what is the accumulated depreciation? The accumulated depreciation now is a 2,000. But let's go to the policy 4. Depreciation charge in the year of acquisition, but none in the year of disposal. So if we want to calculate the depreciation, current year depreciation for motor vehicle, since it's reducing balance, when you take 2,000 from 4,500, and you will get 2,500. Then you apply 5% on it. 0.05 times 2,500. 125. 125. So total will be 2,800. 1,500. So you take your calculator. You take your calculator. 2,800 plus 1,500 plus 450 plus 125. You get 48,475. 48,475. So we are done. Find the total. This will be 12,800. This will be 7,500. That is the total depreciation. Total depreciation 9,450. Then 2,000. So we add 2,000, then we subtract 49, then we add 125, which will be 2076. Then we come to the total depreciation. That's 27,000 minus 49 plus 4,875, which will give us 31,826. These are the respective total depreciation. Then we come to the net book value. We arrive at the net book value by taking the respective non-current assets we have, their total cost. These are their total cost, and we take out or we subtract the total depreciation that we have here. So for land and building, it should be 28,000 minus 12,800, which will give us 15,200. Then plant and equipment will be 15,000 minus 7,500, which is the same as 7,500. 18,000 for office furniture. Then we take the total depreciation 9,450 from it. We get 8,550. Then we come to motor vehicle. Total cost is 4,500. We take the total depreciation 2076 from it, and we get 2424. For the total, sometimes it's very important. Sometimes if time is not on your side, you can just move on, because the total will just confirm when you finish with the statement of financial position, the total non-current assets. You can confirm from here. But if you do it here and you go there, you just list the net book values and you bring the total, because you've already done it here, which will be 65,500 minus 31,826. You get 33,674. So these are the various net book values. Now we are done. So the last thing is that in case the asset that we sold, sometimes people forget that instead of deducting the cost of the asset from the total cost, they rather deduct the sales proceeds. And when you do it like that, you are abusing the accounting concept called matching. You are not matching the real cost to its cost. So the sales proceeds, this is what you do. In case in the question it has not been treated, the sales proceeds will either be debited to the cash or bank account. It should be what? Debited, because here we are deducting, which means we are crediting the motor vehicle. So when you go to the cash or bank account, you add it, that's you debit it. And after doing this, you can find the the profit or loss on sale. Profit or loss on sale to determine whether the asset that we sold, we made a loss. So in this question, in case we maybe we've been given the cost of the asset that we sold was 500. It accumulated depreciation. We want to find the net book value of the asset that we sold. It accumulated depreciation 49. Let's say so the net book value of this asset will be 551. And let me say we sold the asset for, so sales proceeds, we sold it for 600 cedis. Then when it happens like that, we've gotten a profit. And sorry, this is supposed to be 451. We've gotten a profit of, let's take our calculators. 600 minus 451, which will give us 149. To give us 149, that is a profit. It means that the value of the asset at the day that we wanted to sell the asset was 451, and we are selling for 600. We've gotten a profit of 149. So when the net book value is lesser than the sales proceeds, we always make a profit. But when the net book value is higher than how much we are selling the asset, then we are making a loss. And loss on sale or disposal is recognized in our income statement as an expense, but profit on sale or disposal is recognized in our income statement as other income. So when you finish your gross profit, you come to add other income, then you can bring this profit on sale of this motor vehicle. And that's all. If you have any question, you can actually let me know. But don't forget that this is very, very simple. You have to take your time, get a question which actually embodies a lot of these kind of things, and it will help you broaden your horizon about how to treat assets that are being sold or that are being acquired, and it will actually go along with you, make you understand it well. Thank you very much. Have a wonderful day. Bye bye.